Hi, this is Adam Khoo here, and in this video we'll be looking at how we can still find bargains in a stock market that seems really expensive. So I'm sure you've heard, whether you have watched videos on YouTube or you've read reports in the media, everyone is saying that stock market seems really expensive. Even some people are saying that it's a bubble waiting to burst. But is the stock market really that expensive? And is there nothing really left to buy? Well, yes and no. So on one hand, the stock market may seem expensive from a technical charting perspective, which I'm going to show you in a short while, as well as from certain fundamental measurements like the price to earnings ratio. But I'm also going to show you in this video that not all stocks in the market are that expensive. Yeah, there are some stocks that are really insanely expensive. At the same time, if you look under the hood, you can still find some good bargains to invest in. Let's start by taking a look at the technical chart. So from looking at charts, how do you tell if a stock or the market is expensive or cheap? Well, you look at the moving averages. That's why we call them averages. So you find that when the price is far away above the moving averages, we say it's overbought. So it's kind of like a rubber band, right? It stretches, it will eventually come back to the moving averages. And of course, if it's below the moving averages, oversold, and you get the rubber band effect, goes up again. So you want to see where the moving averages are. That tells you where the mean of the market should be. So if you look at different perspectives, if you look at, for example, the monthly candles, which is the long-term perspective, you can see that right now the market is a bit overextended, right? So remember, the market moves in wave patterns, right? You've got wave up, wave down, wave up, wave down, breathe out, breathe in. So what goes up must always come back down before going higher. All right. So again, you can see historically, when you see this, wave up, wave down, okay, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. So during a normal retracement, it hits the red dotted line, the 20 EMA. It goes near the red dotted line, all right? And during a big crash, like a bear market, it will start to hit the blue lines, the 40 and the 50 moving average on monthly candles. So if you see where we are right now, you can see that we are pretty far away from the 20 moving average, from home base, okay? Now, not to say that the market can't go higher in the short, it could still go higher, right? Because again, high could go even higher. That's called momentum. When you're breathing out, you're running out of breath, but could still breathe out even more. So no one can tell the exact top. No one can do that. But you know that eventually it has to come back to home base. It has to come back to this 20 EMA. Of course, as the market goes higher, this moving average will move up together as well. It will move up together with it as well. But the point is that it will come back to it eventually. So if I wanted to buy, for example, shares in the S&P 500, the ETF, would I buy right now? I won't do that because it's a bit overbought, right? I want it to come back nearer to home base, to the 20 EMA before I'll start adding shares. Okay. Now some people say, okay, I'm going to wait for a crash, another crash, for it to go all the way back down to this blue line to buy. Sure, you can do that, but remember that these big crashes happen once in 5 or 6 years. So if you wait for that, then you got nothing to do in 6 years. All right, so you can start to nibble somewhere around there. But right now, you can see we are a bit overbought. We are a bit overextended, a bit overvalued on the monthly charts. Now, if you look at the weekly charts, going to the weekly candles, you can see, again, we are a bit overbought. Again, look at the wave patterns, right? You can see, wave up, wave down, wave up, wave down, wave up, wave down. Wave up, wave down, wave up, wave down. So notice that during the normal retracements, it will find support again at the 20 and 40 EMA, the red dotted line and the blue dotted line. So right now it's waving up. It's again getting a bit overstretched, right? Breathing out. Would I want to get in here? No, I won't, right? Again, it could go higher, You never know how far it could stretch, the rubber band. But eventually, boom, it's going to snap back to at least that 20 EMA, a normal retracement. Of course, you could snap back more, and if it's another bear market, boom, could go down there. Again, these bear markets don't happen that often, normally once every 5 to 6 years, although we did have two bear markets in a span of 2 years. But this was an artificial bear market. We got the pandemic, right? It's not a normal recession. It was an artificially induced recession because of the pandemic. And this thing happens like once in 100 years, right? So if you take that away, then usually you have this big snap down once in, again, 5 to 6 years. So again, my point is this. We could go higher in a short term, but I won't be a buyer right now of the S&P as a whole because, again, it's a bit overstretched. Okay, so again, on the charts, you can see market looks a bit expensive. How about fundamentals? Now, there are many ways to look at fundamentals. A very common measure is the price to earnings ratio, comparing the price of the companies to the actual earnings of the companies. If you look at the price to normalized earnings of the S&P 500, it looks pretty scary, it looks pretty darn expensive, okay? So in the last 20 years, the PE ratio, again, price to earnings. So you take basically the share price of all the companies in the index, the 500 companies in S&P, the market capitalization, you divide it by the actual profits it makes. All right, so obviously the lower the figure, the cheaper the market is. The higher the figure, the more expensive the market is. So you can see that historically in the last 20 years, the average PE has been 21 times earnings. What does it mean? It means that for every $1 that the company earns, that an average company earns in the index, you are paying $21 to buy that company. So theoretically, you need 21 years to break even if the earnings don't change, right? It's like you make a dollar takes 21 years to make your $21 back. Of course, in reality, the earnings don't stay the same. The earnings will grow from $1 to $2, $3. So that's why people are willing to pay 15, 20 times earnings. Now, where are we right now? So you can see currently the PE ratio is 41 times up there, which is way above the historical average. Remember, anything above 21 is supposed to be above the average value, and below 21 is below the average value. 41 at all-time high. So that's why there's some people saying that this market is insane, it's a bubble, it's gonna burst, it's gonna die, right? Do I agree with that? Not really, okay? So what's my point? What am I saying here? So should we get rid of all our stocks and hold only cash? No. Not being invested at all and just keeping cash under your mattress is not a good idea. Why? Because with all this money printing, right, cash will lose value over time because of inflation. So if you think about it, if you don't invest your cash and just hold cash, what's happening? Basically, if there's an inflation of 2% a year, not right now, but soon, it means that every year, your cash is losing 2% of its value. You're losing 2% of your wealth every year. Times 20 years, that's more than 40% compounded, which means every 20 years, you lose like 40% of the value of your wealth. So it doesn't make sense, right? How about, buying bonds? Now, the long-term 10-year bond is now only paying an interest of 1%. 1% interest if you buy bonds, right? So imagine you get 1% interest, but you lose 2% to freaking inflation, all right? You are still down 1%. So in real terms, you're still losing money if you hold cash or you buy bonds, okay? Now, currently the PE ratio seems pretty high at 41 times, but here's the thing. Now, what happens if you invert the PE ratio? If you take the earnings, divide by the price. This gives you the earnings yield, which means for every $1 that you're paying, how much earnings are you getting, right? So if you invert 1 over 41, you actually get 2.4%. Okay, so that's better. So getting a 2.4% return on your money is better than getting nothing with cash and better than getting 1% with bonds. So although stocks are relatively expensive based on history, stocks are still attractive versus bonds and versus just holding cash. And given that interest rates are now again near zero and inflation would come into the picture, being invested still makes sense. But having said that, we have to be careful to invest only in the right stocks. that are not insanely expensive. We have to invest in stocks that are reasonably priced or even undervalued, and avoid those that are really, really expensive. Yeah, they could still go high in the short term, but eventually they will burst. And if you just hold those expensive speculative stocks, you get really hurt when the bubble bursts. Somebody gonna get hurt real bad eventually. When the bubble bursts on speculative stocks, you can bet they're gonna fall really fast and really sharp in a straight line. Why? Because a lot of these speculative stocks are bought on margin. What does it mean? That means the retail traders are borrowing money from the broker and using the borrowed money to buy stocks and chasing up the price at ridiculous levels, right? So what happens when you use borrowed money to buy stocks? Sure, as it goes up, you make a lot of money. You get insanely high returns. That's how people get 1,000% a year and they think they're geniuses, right? But eventually, when the price starts dropping and the value of the account drops, what happens? The broker would say, hey, now you got to pay us back the money, okay? And most traders, they can't pay back the money because they don't have excess cash to put into their account to make up for the losses that they have by investing borrowed money. And what happens when they can't pay back the broker on time? The broker will issue a margin call. If you can't meet the margin call, the broker will force you to sell your shares. So when that happens, a lot of traders are forced to sell their shares, and that creates even more selling, and that triggers even more selling, and it's a domino effect, and that's when you get a waterfall cascade and stock prices just collapse. And that's when people get killed. Now, what's really scary is if you take a look at this chart, you can see the red line is the amount of margin debt growth, the amount of money people are borrowing to buy stocks and chasing stocks to crazy levels, right? And you can see recently, my God, it has gone up in a 90-degree line. The growth is like, we call that parabolic, right? Parabolic. And usually what follows parabolic is crash, crash, right? Really scary stuff. Now, if you take a look at this chart, you can see again, the blue line is the S&P 500, the stock index. The red line is how much people borrow to buy stock. So you find that oftentimes when the borrowing gets insane, because when the stock keeps going up, people get more confident, they borrow more, and it goes 90 degrees. And soon after that, you'll find the market will then collapse and these people will go bankrupt because they can't pay back the loans. And then the cycle will start again, right? And again, you see, market goes up, they get confident, they borrow money, goes up 90 degrees, collapses again, right? Now, you can't predict exactly when it's going to collapse. No one can predict. But what's scary now is you see, again, as the market's going up, people getting too confident, borrowing money, buying, certain crap companies that are not worth anything, they are losing money, and it's going up 90 degrees again. That's right. You may see a reckoning in a short while. Now, again, I'm not saying sell all your stocks. I'm still invested in the markets, right? But what I'm saying is be careful. In your portfolio, ensure that you don't hold too many speculative stocks that are overvalued, that are over expensive. Because these are the stocks that can drop easily 50, 60, 70% and never come back. But if you hold solid, fundamentally good businesses that are making good profits, a good cash flow, and they're reasonably priced, don't worry, you'll be buffered. If the market collapses, your stocks will hold their value. The trouble is a lot of traders out there right now, they are even buying stocks that are not making money. They are making huge losses, but they're buying it on the promise that one day it'll make money. And that is a scary part of it. Well, one of the most important things you need to do as an investor is to know how to identify what is a cheap stock and what is an expensive stock. So here's a quiz. I'm going to give you 5 minutes or 10 minutes, pause the video and do this homework, and we'll come back and I'm going to review your results. Here are 4 stocks. You've got Amazon selling at $3,292 per share right now, roughly about that, right? NIO, that makes electric vehicles, selling at $61 per share. Snapchat, right? Social media selling at $53 per share. Finally, Lockheed Martin, which is the largest military defense contractor. They make these F-16 planes, missiles, right? And they're selling at, right now, about $339 per share. I mean, plus or minus because the market goes up and down. So, I want you now to take a few minutes, pause the video, and I want you to rank these stocks from the most expensive to the cheapest. And let's see if you get it right. So before we reveal the answer to that quiz, you need to understand what makes a stock expensive and what makes a stock cheap. First, understand that when you buy a share of stock, you are actually buying a piece of a business. You're buying a share of a company. So the question is the business expensive or is the business cheap? Whether it's expensive or cheap depends on comparing the price of the business or the share to its real value. What is it really worth? We call it the intrinsic value. So how do you estimate the value or the intrinsic value of a business? Remember that a business is nothing more than a money-making machine. It's a machine that generates money, or we call it profits or cash flow. So how much this machine is worth depends on how much cash it can generate over its lifetime. So here's a very simple analogy or an example, right? So let's imagine there's a money-making machine, MMM. And this machine makes $1. It generates $1 right now in year 0. Question, how much is this machine worth? What's the intrinsic value of the machine? It's worth $1, right? Because if you pay $1 for it, it prints $1, you get your money back, you break even. Simple as that. Okay. So what if the machine prints $1 now, and 1 year from now it prints another $1? What is this machine worth right now? It's worth $2, correct? Well, actually it's worth less than $2 because you gotta wait a year to get the second $1. So you put a lower value to the second $1. But to keep it simple, let's just ignore the time value of money right now and just take it as the machine is worth $2, okay? Let's just keep it simple. What if this machine pays another $1 2 years from now? So it pays $1. What is this machine worth? It's worth $3. Make sense? So the machine is worth whatever it can give you, okay? And if this machine prints $1 every year for say 20 years, realistically, what is this machine worth? Well, simply the machine would be worth $20, right? $1 a year times 20, the machine is worth $20. Now, but you have to consider the time value of money, because $1 received in the future is worth less than $1 received today, because you got to wait, for example, 5 years to receive this $1. So it's going to be worth less to you because of the opportunity cost of your money. So we have to do this thing called discounting. So future money that is made has to be discounted by an opportunity cost, or we call it the discount rate. So for example, this $1 may be only worth 99 cents, and this could be worth 98 cents and 97 cents. For example, I'll just give you an example, right? But the point is, roughly, the machine would be worth not more than $20. The machine would be worth less than $20. Okay, that's the value of the machine. So realistically, if you buy this machine, how much would you pay? You will not pay more than $20. If you pay more than $20, it doesn't make sense, because if you pay more than $20, you only get $20 back. But a lot of people do that, right? They buy a stock or business and they pay a price higher than the intrinsic value. Okay? Now, if I told you that you could buy this machine for, say, $5 right now, you pay $5, you get this machine, it pays you $1 for 20 years, is that a good deal? Yes, because now it's undervalued. You're now buying the machine for less than what it can pay out. Does it make sense? So the same thing happens when you buy a business or a share in a business. You gotta find out how much money the machine or the business is gonna generate over the next, say, 20 years. And you gotta discount that money to present value. And then once you know that figure, you then ensure that you pay a price that's lower than the figure. That's a good investment, because you pay $1, you get back more than $1. But if you pay $1 and you get back less than $1, then it's a stupid investment. Now, of course, in reality, the business doesn't pay $1 every year. In reality, businesses grow, right? So over time, McDonald's will sell more burgers, Nike will sell more shoes, so on and so forth. Apple will sell more and more gadgets, right? So over time, it will print more and more money, right? So $1 today and maybe $1.20, $1.40. So there's a growth in the earnings, right? So that's a simple analogy. So right now, we're going to take a look at those four businesses: Amazon, Neo, right, Snap, and Lockheed Martin, to find out, okay, think of them as a business. How much money do we expect them to generate in the next 10 or 20 years? And we add all that money together, that's the value of the business. And what's the price selling at right now? Is it selling above or below that value? So let's start with the first money-making machine, Amazon. So you're going to figure out Amazon as a business, how much cash is it going to generate in the next 20 years, and we're going to discount that to present value to know the value of the whole business, and we divide it by the number of shares to calculate the value per share, the intrinsic value per share, and then we compare it to the current share price to see if it's expensive or cheap at this current price. To help me do this, I need an intrinsic value calculator. Now, in reality, Amazon as a business is going to last for many, many years, maybe 30, 40, 50 years. But to be really conservative, let's just assume that this machine will only generate profits and cash flow for 20 years. Anything above that, it's a bonus. All right? Okay. So you can see that currently Amazon is generating $26 billion a year in free cash flow, right? This is free cash flow. So it's kind of like the machine is printing that $1 right now. So we got to estimate how much it's going to print in 20 years based on the growth rate. Now, Amazon is currently growing at 34%. So it can't grow at 34% forever. So we need to make some assumptions that for the first 5 years, it will grow at 34%. And the next 5 years, the growth will halve to 15%. And the next 10 years, the growth will just be 4%, which is basically the GDP of the US economy plus 1%. These are standard assumptions we make. So this means that this year, Amazon, the business, will make $26 billion in cash flow. Next year, you'll make $36 billion over there, $49 billion, $66 billion, $89 billion. So we project how the cash flow will grow in the next 20 years. It's like dollar, right? But money in the future is worth less than money today. So we're going to discount the future value to present value. We're going to add all this together and discount it using an appropriate discount rate based on the beta of the stock. Okay, and this gives us an intrinsic value over here of 3733 based on the number of shares. You're going to divide it by the number of shares. So the intrinsic value of Amazon is $3,733. But remember that Amazon currently has debt of $35 billion in debt. So if you divide it by the number of shares, that gives you a debt per share of $69, which means every share you own of Amazon, you have to pay debt of about $69. But Amazon has $71 billion in cash. So you divide that by number of shares, that's $142 cash per share. So Amazon has more cash than debt. So it nets off to be a positive as well, right? So if you take 3733 minus the debt plus the cash, it gives you the final intrinsic value of the share, $3,800. There you are. So with this calculation, you can see Amazon is worth $3,800 per share. Why? Because that's the amount of cash it will generate for the next 20 years. Anything above that is a bonus, right? And right now, the share price is roughly $3,292. So is that cheap or expensive? That's cheap because you're buying something worth $3,008 for only $3,003. So you're getting currently a 13% discount on Amazon shares. So verdict, Amazon is cheap. It's cheap by 13%. On the list, Snapchat. Snapchat is trading at $53 per share. Is this expensive or cheap? So we've got to do the same thing, right? Snapchat is a business, a money-making machine. We got to figure out how much money it's making now and project how much money it's going to make in the next 10 or 20 years, for example. And We then got to divide it by number of shares to calculate the value per share and compare that to the current share price. There's a problem. The problem is Snapchat is not making money. It's losing money. So you may be saying, so is it worthless? No, it's worth something. Why? Because people believe that one day it will make money. So we got to make an assumption of how much we think it's going to make in the future, although it's losing money today. You can see that Amazon is a business, is a machine that really prints money. This is from Guru Focus, one of my favorite websites, and you can see right here and right now, Amazon is, selling more and more products, right? The sales revenue is increasing consistently. You can see over here, the one in blue would be the net profit is increasing consistently, and the one in green, the free cash flow, which is the most important thing, is also increasing consistently, and the operating cash flow is also increasing consistently. All right, so it's a machine that is printing money, and it will print more and more money in years to come. But if you look at, for example, like Snapchat, because it's a relatively new company, not profitable yet, you can see it's trading at $53. So you're paying $53 for a piece of a machine that is not making money yet. The machine is in fact, taking more of your money and not giving you any money, right? So you can see that revenue is growing, but it's making losses. Although it's making less losses, losses are reducing. You can see free cash flow is negative as well, all right? So in such a case, if the machine is not making money, how do you figure out what the machine is worth? Well, you have to guess how much you think the machine will make eventually. So how do we guess? So we can guess by looking at the current sales revenue, right? So right now it is making sales, and the current sales revenue is $1715 million, right? So $1.715 billion, right? So based on the revenue, can we guess what the net profit will be when it eventually becomes profitable? Yeah, we can make a guess. Why? Look at Facebook. So Facebook is also in social media, right? And Facebook is already profitable, and Facebook's net profit margin is about 28%. So for every $1 in sales, Facebook makes 28 cents in net profit. So if we apply the same profit margin to Snapchat, we can guess its eventual net profit. Got it? So we take 28% times the revenue to estimate the net profit eventually when it does make money, right? So the estimation I got is $600 million. Okay, and that is if it becomes profitable. So there's a big hope it will be, right? So you're hoping the machine will make money one day, and when it does, it will make $600 million, right? Right now, Snapchat has $2.7 billion in debt and $1.6 billion in cash. Next, we have to project how much money it's going to make in the future. Now, for Amazon, I'm confident to make a 20-year projection. For Snapchat, no. I'm only willing to make a 10-year projection. I'm only willing to estimate how much money it's going to make in 10 years because it doesn't have a solid, wide, competitive mode yet. All right, so I'm going to project it for 10 years instead. So at what growth rate do I use? So if you look at this other website, which is really great, Simply Wall Street, you can see the projected growth rate for Snapchat. The profits are projected to grow at that 59.8% growth. Sounds great, right? So let's put it in 59.8% growth. Now, we can't expect profits to grow at 59% a year for 10 years. Not realistic, right? But let's be really optimistic and assume that profits can grow at 59% for 5 years. And that's already really optimistic. And let's assume that the next 5 years, it will then grow at 15%. You may say, why 15%? Because that's the normalized growth rate of most tech companies. That eventually when the growth reaches its equilibrium, right? So that's how we get 15%. Now, how many shares are there in Snapchat? There's 1.47 billion shares. So put in all these numbers and boom, it will calculate for you the intrinsic value of Snapchat is, ta-da, $22.80. Okay, $22.80. By the way, if you look at Simply Wall Street, they give an estimate valuation as well. I'm not sure how they calculate it, but they estimate Snapchat to be worth $25. So they are a bit more generous than me. So they calculate the value at $25 and I calculate the value at $22.81. So they are a bit more optimistic than me, $22.81, right? So based on the current share price of, what's the current share price again? 53.57. Let's put that in, 53.57. Snapchat is really expensive, right? It's selling at 134% above its value. So it's kind of like you're buying a machine that's going to pay you $1, but you're willing to pay $2 for that machine, right? You're overpaying for the machine. And conclude that Snapchat is a lot more expensive than Amazon. We've got 2 more to go, NIO and Lockheed Martin. So with that, I'll see you guys in part 2 of this video. Remember to subscribe so you get part 2 once it's out. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.